Good morning from London. I'm Kriti Gupta alongside Lizzy Burden and Tom Mackenzie. We're an hour away from the opening trade. Here's what you need to know. Earnings breaking on both sides of the Atlantic as companies start to reveal the first round effects of tariffs on their bottom lines. From Apple to Shell, we're going to dive into the details. And China says it's assessing the possibility of trade talks with the U.S. and early signs of a thaw between the world's two largest economies. Plus, it's Jobs Day in America. Economists expecting U.S. hiring to slow as trade policy risks chilling hiring decisions. Lizzy.
Well, a very happy Friday, Kriti. You've got optimism injected into the futures picture this morning. China thinking about talking to the US. And you've got futures higher on the Atlantic side of the European side of the Atlantic as well. Gold is actually higher this morning. Euro dollar at a 113 handle. The countdown to the opening trade starts right now.
Happy Friday to everybody. Welcome to the opening trade. We've got plenty to digest. We've got the geopolitics, but also plenty of corporate earnings. You're starting to see the tariff policy seep into some of these numbers. We're going to dive into this from the tech space that we got those numbers overnight. But let's kick it off here this morning with the European earnings, because as we speak, Shell is putting their numbers across the Bloomberg terminal here, announcing a share buyback program. Get this, $3.5 billion. That seems to be the red herring there, in that a lot of these companies worrying about tariffs, putting out some indications that things might get hairy in the next couple of quarters, but not touching their buyback programs. I think that's very interesting, especially as their first quarter adjusted profit comes in slightly better than expected. But you look at that first quarter cash flow from their operations, and it's coming slightly weaker than the street was estimating. So a little bit of a mixed picture when it comes to Shell.
I would say top line, this is a pretty solid beat in terms of Shell in the first quarter, on adjusted profit at least, 5.6 billion, so well above the estimates, comfortably above the estimates, in an environment, of course, of lower oil prices. Citi suggesting that you could get below $50 a barrel on oil, depending on what OPEC Plus does in terms of putting more oil on the market. RBC analysts, interestingly, before the year's earnings, had flagged the, and I'm quoting, fortress balance sheet of Shell and its potential then to navigate the commodity downturn. And at least top line, these numbers seem to suggest that Shell is navigating the pressure on oil pretty well. The trading unit is going to be interesting in terms of how they've taken advantage of that volatility. The share buyback of $3.5 billion.
Yeah, interesting that Shell, as you point out, Kriti, holding on to that buyback when BP cut the buyback, and we get Chevron later. They're expected to cut the buyback as well when they report as well. So, as you say, Tom, this fortress discipline from Shell working for them for now. But we've also had results just now from NatWest, and you're looking at pre-tax operating profit in the first quarter coming in at £1.81 billion. The estimate was £1.56 billion, so a beat there. And then when it comes to net interest margin, 2.27%, the estimate was for 2.25%, a beat there as well. Look, the structural hedge is helping NatWest here to shield them through the rate volatility. It has been doing throughout the period, more so than their peers. You've got 4 cuts fully priced now from the Bank of England this year. It'd be interesting to see how they weather that, but it's been working for them so far.
Absolutely. It's not the only banking news we had out this morning. Of course, around NatWest, Standard Chartered, I believe you just had spoken to the CFO as well amid a fairly decent profit beat there. Yeah,
and obviously, look, a very different animal versus NatWest with its exposure, of course, to Asia, Africa and emerging markets. Really interesting to hear from the CFO in terms of asset allocation. Not seeing a major asset allocation shift away from the US, and he was pretty conclusive on that. And this is a bank that they say they are benefiting from the volatility. Their clients are coming to them and saying, how do we adjust to the supply chain ruptures? And they're going to Standard Chartered and they're being able to provide that service. That is the narrative we're hearing from Standard Chartered. And interestingly, they are sticking to their program around handing back to shareholders $8 billion by 2026. They've done $5 billion already. They say that despite all the volatility and the tariff impact, they can do another $3 billion within that period. The stock is up about 13% year to date. This is a bank that is heavily exposed to that rupture around the supply chains and the trade war, and yet they are benefiting on volatility and clients not radically shifting their asset allocation out of the US at least yet.
And that has been the theme you've seen from banks on both sides of the Atlantic, and that their balance sheets are so cushy, and arguably you can make that same argument in the energy space as well, with likes of Shell, likely, as Lizzy said, Chevron, Exxon later today, but also the tech space, starting to see some of those balance sheets take a wobble, I think is a fair way to put it.
Look, the balance sheet of Apple is unquestionably strong and sizable, OK? So, you know, they have huge cash piles, Apple. But I think what we tried to flag to our audience yesterday was that you can take Microsoft and you can take Meta and you can separate them out from the story around Apple and around Amazon. Both those stories different as well. But the idea that that tech optimism was going to continue into the session today, I had that question mark over that yesterday, specifically because of the way that Apple is exposed, not just to the tariffs. It hasn't answered the question on AI. It hasn't really fully answered the question on supply chains. Yes, they're shifting some to Vietnam and India, but those countries are also impacted by tariffs. It is still not answering the question about how it resolves the demand picture in China, and we had a reminder of that. And services that had performed so well for Apple, huge question marks about that as well as a result of regulatory scrutiny. So there's some major questions that Apple is unable to answer. On Amazon, they guided lower in the current quarter than the estimates, and that's where the concern came through.
Yeah, flagging those recessionary fears, not mentioning tariffs directly in the guidance, but then Andy Jassy talking about tariffs in his commentary later on, just again repeating this narrative that they don't know where the tariffs are going to settle, the uncertainty continuing. Look, the future depends also on the fate of Shein and Temu. When you've got de minimis ending today, Amazon tiny bit affected, well, slightly affected by that, but operating profit forecast weaker than expected. It's difficult for Amazon as well.
I think the tariff read-through is interesting because you mentioned it there. The number was less than I was expecting simply because in the same week we've heard from General Motors, which talked about a $5 billion impact from the tariffs alone. Apple's saying only $900 million.
Yeah.
And that seems to me, especially given their exposure, a much smaller number than expected. I think the other piece of this is that this is only the early data. The next quarter may actually see a little bit more pain.
And I should give them some credit. They got the carve-out from the Trump administration for their iPhone shipments into the US and other electronic devices. So they do have that. But as you say, 900 million, top line, it's a big number, just shy of $1 billion, but versus the automakers. The other question is, to what extent is the pull forward in shipments and purchases, both for Amazon, from their clients, but also from Apple clients as well? That washes out, right, in June, July. So how is that going to be a pressure point going forward, given that the demand pull-through is there?
Yeah, the inventory story is certainly a key one, and that brings us right to the economic story as well, because, of course, with a GDP number this week, a contraction in the United States, does the jobs data show it today? Yeah,
and that point that maybe this isn't the data that shows the difficulties yet. It's the same story as earnings. When you look at the jobs data, our economists saying that the May report that comes out next month is perhaps where you see the trade impact more visible in these numbers. You've got traders more pessimistic than economists when you're looking to the payrolls number. The whisper number 120 the last time I looked. Consensus 135k, so down from 228k. But look, this cooling of the labour market is obviously going to put pressure on the Fed to cut rates at this point.
Absolutely.
I wonder to what extent corporates have been hoarding those workers, and they've seen that impact, of course, through COVID. They were punished as a result of letting workers go. When does that story start to ebb? When does that story start to break and flood the labour market of the US? We're not there yet.
Yeah.
And how does that tie into the Fed's thinking in terms of balancing inflation versus the jobs market?
So no layoffs just yet, to your point, but perhaps just that chilling of hiring decisions, as Lizzy was pointing out. The other piece of this is going to show up some of the federal layoffs that have been showing up from Doge and from Elon Musk, et cetera. It comes at the same time, especially for bond markets that you mentioned are kind of jittery. Scott Bessent talking about why the Fed should cut, saying the market is pricing in, I believe the words were, a two-year yield trading below the Fed funds rate. It's not quite how the bond market works, but he thinks it is.
Exactly. Larry Summers saying this is analytically unsound and problematic. You know, just because the market's pricing it doesn't mean that it should happen or that the market's saying it should happen. And again, undermining Fed independence. Speaking of Treasuries, interesting as well that you've got the Japanese finance minister saying not only now we hold them, lots of them, by the way, but we could use them as part of the trade talks with Washington. So that is a big stick to be dangling.
Absolutely. Fund flows perhaps moving the bond market more so than the expectations of whether or not the Federal Reserve should be cutting rates, ultimately pricing in a recessionary scenario. We're about halfway there based on the data we got from the GDP this week. Let's talk about who else we've got coming up on the show. We can pose all of these questions to them. Kriti Gupta, Wisdom Tree Director of Macroeconomic Research, will join us shortly. Plus, Carol Knackley, Crystal Energy's CEO. And then, of course, Ronald Temple making a trip from the States over to join us and grace our sets this morning. Lazard's chief market strategist there. And then the eco conversation continues, especially on the nuances of this payrolls report. Freya Beamish, T.S. Lombard's chief economist.
On the data front, 10 a.m. UK time, Euro area CPI, the inflation story as well. Do you continue to make progress towards the ECB's 2% target, with markets now pricing in around 70 basis points of additional cuts from the European Central Bank. That will be informative. We'll break that for you, of course, the team at 10 a.m. UK time. Then at 1:30 p.m, it is the big one in terms of the jobs data. We've broken that down for you. Non-farm payrolls dropping at 1:30. Keep an eye on average monthly hourly earnings as well. Expected to tick up, actually, to 3.9%. Before the US markets, on the earnings front, Exxon, talking of oil, we've had the Shell numbers, of course, and Chevron earnings come through. To what extent is there divergence still when it comes to the US and European energy majors and that story? And the de minimis trade tariff exemption has ended. Lizzie was talking about Temu, and of course Shein impacted by this as well, trying to onshore a lot of the production, well, the shipments at least to the US, not the production of T-shirts and trainers so much, but the shipments and warehousing in the US, and to what extent they try and adjust around that. So far, Temu saying, look, we're not going to raise our prices. I wonder how long that can be sustained, because they built up the inventories in their warehouses in the US, but at some point they're going to have to restock and refill. And if you don't have a resolution on trade, then that surely is going to have to lead to higher prices. But for now, they're absorbing, it seems, some of the cost or offsetting that.
Yeah, absolutely. And the timing around that Amazon had kind of addressed that are interesting as well. But this sets us up nicely for what the next kind of maybe leg of negotiations look like. If we're talking about China's maybe thawing to at least coming to the table, let's see what that actually yields. And then don't forget that we also have conversations with the EU coming up in the next couple of weeks as well. The FT having a interview with Minister Šefčovič, the trade commissioner over there from the EU, talking about opening a door to things like U.S. gas and agricultural goods. Are those the same tools that you use for China or Japan?
Yeah, that's the carrot that he's dangling. The stick he's saying is we aren't going to accept this 10% minimum tariff. Is that something that Donald Trump can get on board with? We'll have to see. But that FT interview, one to keep in mind. Now, here's what else you need to know this morning. In terms of the retail space, London luxury department store Harrods has reported hacking attempts just days after two other UK retailers said that they were targeted. Harrods says that it's taken steps to keep systems safe and has restricted internet access at its sites, but stores do remain open. Marks & Spencer Group has recently been battling a cyber incident that rendered some of its systems inaccessible. Elsewhere, President Trump says that he'll nominate Michael Waltz, his current national security advisor, to be the next US ambassador to the UN. Marco Rubio will serve as interim national security advisor while keeping his job as Secretary of State. The development comes after Waltz admitted to adding a journalist to a Signal group chat discussing sensitive attack plans. And President Trump has threatened to impose secondary sanctions on nations or companies buying Iranian oil. The move targets a major revenue source for Iran and comes as nuclear talks planned for this weekend are postponed. Sanctions could also further inflame tensions with China and the UAE, both of which buy petroleum products from Iran.
Certainly negotiations we're going to keep an eye on. Add to the list of talks happening between D.C. and the rest of the world. Coming up on the program, Danske Bank CEO joins us for an exclusive conversation to discuss their earnings picture and a pretty strong week for European bank results broadly. Plus, we continue the conversation on the tech front. Amazon optimistic, Apple cautious. The two Mag 7 members showing some divergence on the outlook. We're going to dive into the details shortly. And up next, we go right back to the markets because at the end of the day, it is jobs day in America. What are they pricing in? We're going to have the details for you. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
There's been a substantial decrease in the 10-year since beginning of the year, but especially since January 20th. And President Trump and I are targeting that point on the curve. We are seeing that 2-year rates are now below Fed funds rates. So that's a market signal that they think the Fed should be cutting.
A 60 basis point move from the election of Donald Trump to the current day, 422 on the 10-year yield. Of course, the signal that perhaps everyone in the market is watching when it comes to not only the currency market, the bond market, but the equity market as well. Valerie Titel watching this very, very closely. Val, Walk us through it.
Kriti, the equity market is on an impressive run. We've notched 8 straight days of wins for the S&P 500, and we're looking like we could make it 9. The S&P 500 futures in the last 9 days, Kriti, us up over 9%. If we end in the green today, it could be one for the history books. We have not seen a 9-day streak in the S&P 500 in 20 years. We have to go all the way back to 2004 to see a comparable run. I don't want to jinx it, but the longest on record is 14 days back in the 70s. Now, that's the state of play for the equity market. The Treasury market has ended its streak of gains. We actually saw an abrupt rise in 2-year yields yesterday, rising some 10 basis points in the session. This was after some strong manufacturing data from the ISM, and the new orders component, actually, Kriti, the more forward-looking component, came in better than expected as well. But the data doesn't end there. It's jobs day today. We got NFP dropping at 1:30 p.m. UK time. The expectation is for 138K and the unemployment rate to remain steady at 4.2. Many economists out there think that today's print could be the last strong print before we get some tariff-induced weakness in the May and June prints later.
Bloomberg's Vary Titel walking us through the numbers to watch. If today's numbers are bad, maybe they might just get worse over the next couple of months. We thank you so much. Let's get a little bit more on that very concept. Kriti Gupta, Director of Macroeconomic Research over at Wisdom Tree, joins the program this morning. Kriti, a pleasure to have you as always. Happy Jobs Day to you from London. Talk to us a little bit about whether the payrolls data actually even matters when the markets are likely pricing in more of the trade impact. What do we pay attention to in the data set today?
Yes, it's surprising, Kriti, on a day like Jobs Day, all the focus typically tends to be centered on the jobs data. But I think this time around, the focus is going to be centered on how well these talks are progressing between the U.S. and China. That has been the biggest layer of uncertainty in global equity markets and in financial markets. And hence, any sliver of hope that we can get that the U.S. is promising or working towards negotiating a trade deal with, a number of trading partners, and China primarily, will be extremely important and would remain a dominant focus for markets.
Kriti, where do you stand on the recession calls here? There's so many folks who are saying that at the end of the day, if you're going by the technical definition of a recession, which is 2 negative quarters of contraction, we're already 50% of the way there. But it's not matched by layoffs or widespread layoffs when you look at the jobs market. When do the two collide?
It's a great point, Kriti. If you look at it, in every recession since 1982, profits were falling as a percentage of GDP. This time around, U.S. profits are sitting at a record high at 13.5% of GDP. So that's another indicator that, if this recession is in the making and it is coming, it is unlikely in the near term. It also confirms, the current health of the corporate sector, which remains very robust. So if anything, is expected to transpire, the uncertainty around trade will be the big precursor to push the economy into a recession. Now, obviously, given the fact that we are seeing a change in the narrative, Trump working towards trade deals with a number of key trading partners, that could also help allay some of those concerns.
But Kriti, how much do those trade talks with nations other than China really matter for risk sentiment at this point? Yes, they're talking about having formal talks between the US and China, but if those stay frozen really and don't lead to much, how much can this market be boosted?
Well, the key thing that we're seeing in markets right now, especially from the earnings calls, are, many companies are unable to even provide forward guidance because of the tariff uncertainty. Just last night, we've heard from Amazon, we've heard from, Apple, which are so closely tied to international trade. Their earnings announcements, were much weaker in comparison to Microsoft and Meta the previous night. That had a much more optimistic call on their earnings outlook, and it just provides that important outlook that when it comes to trade, those companies that have a more diversified supply chain, those companies that have that higher exposure to global markets are likely to be face a bigger hit from this tariff uncertainty. So if we do get, a lowering of rates, a lowering of those tariff rates come through, that will alleviate some of the excessive risk on these company balance sheets. Take, for example, even central bank meetings. They are echoing, tariff uncertainty. We've had the Bank of Japan meeting this week as well, lowering and growth forecasts, lowering the inflation projection, and then postponing this possible rate hike that was to take place in 2025. And I think that is also echoing this message that global financial markets have been impacted in a very big way by this tariff uncertainty.
Yeah. But, the market jumps on, it gets so enthusiastic every time there's a hint of progress on these trade talks. But does it not need to acknowledge that there's only so far you can go with talks with China when Trump needs to get his tariff revenue somewhere?
Well, I think the big difference between previous recessions and previous crises that have been caused, they were caused by events that were unmanageable. So we've had the COVID crisis, we had the Great Financial Crisis, and events such as these. But in the case of this time around, what we're seeing is it's a self-induced crisis whereby we still have room for negotiation. We still have some room to avoid escalation of tariffs, rising to unprecedented levels. So if there is a ray of hope, if there is a possibility of working towards achieving that, then that would help, bring back a risk-on environment, as we're seeing this morning, and help allay a lot of those concerns that are actually looming on markets, especially once these, the 90-day tariff cool-off period is called upon.
Anika, good morning. Tom here, alongside, of course, Lizzy and Kriti. I'm quoting from your note to us. Attractive valuations and cyclical recovery support tactical overweight for European equities. How do you factor euro strength into that view?
Yeah, that has become a big headwind for European exporters, especially those companies that have a very, very high export market globally. But what we are seeing is that there is a bifurcation taking place within European markets. So more of the value-oriented sectors, which are less reliant on global trade, they are actually performing a lot better than the European exporters. So we started the year with the European exporters, outperforming the market. Trump comes in by April with the Liberation Day tariff announcements, and the exporters just get gulled. And obviously, the stronger euro is having a big impact on the earnings for these exporters. But at the same time, the stronger euro is also bringing back those international flows into the European market. So investors who are rotating out of US exceptionalism, now calling it US unexceptionalism, into Europe, into Japan, back into China, they are now being lured in by a stronger euro, which has been one of the best performing currencies in 2025. So it's a double-edged sword in a way.
Kriti Gupta, Director of Macroeconomic Research at Wisdom Tree, we thank you for your analysis. Of course, we had European equities on holiday yesterday, and we're looking at futures pointing higher as we head towards today's session. Euro Stoxx 50 futures are up 1%. FTSE 100 futures up 0.6% as we head towards the open. But coming up on the programme, President Donald Trump moves to cut Iran's oil sales as nuclear talks stall. We're going to discuss the oil outlook with Carol Narkle, founder and CEO of Crystal Energy. That's next. This is Bloomberg. Thirty minutes from the start of the opening trade. European equities coming back off the holiday this morning. Futures pointing higher. Euro Stoxx 50 futures up 1.1%. Bit of underperformance from FTSE 100 futures as we head towards the open. Across the pond, the S&P is set for its 9th straight winning session. It's first since 2004, as Val was pointing out. So, Kriti, we are risk on this Friday.
Risk on, they're showing up in the bond market as well. Take a look at how these European bonds are opening. I'm seeing 2 to 3 basis points of a move on the 10-year across the continent. A similar move move, or actually a similar direction to what you're seeing in the Treasury market as well. But 3 basis points on a Friday between a bank holiday in continental Europe and a weekend is I think, is a pretty decent move.
Yeah, it's pretty reflective, isn't it, in terms of how these bond markets are adjusting. Non-farm payrolls later today, of course, could see further adjustments along the curve. That at 1:30 p.m. UK time. In commodity space, wow, oil. It's dropped about 15% just in the month of April. The lines keep coming through in terms of how to think about the oil space, whether it's on the macro front, of course, or on the latest threat around sanctions of Iranian oil, secondary sanctions, because President Donald Trump has said he would impose those secondary sanctions on nations or companies, so think China, buying Iranian oil. The move ratchets up pressure, of course, on Tehran as nuclear talks with the US hit a snag. That is the pricing over 2 weeks on Brent. Prices are up in the session today on this news, but how sustainable is that? Let's bring in Carol Nachali, founder and CEO of Crystal Energy, always on point when it comes to what is happening in the oil space. Carol, thanks for joining us. Are the markets underpricing the geopolitical risk around Iran and secondary sanctions?
I don't think they are underpricing the geopolitical risk premium, partly because, first of all, geopolitical risk premium is relevant, more relevant when we have a tight market and prices are really high. We tend to pay more attention to that. But at the moment, you can see prices are struggling to go in the high 60s. And already we know about President Trump's agenda vis-a-vis Iran. I mean, they were never friends, and they are unlikely to be friends anytime soon. But the announcement today confirms, or yesterday confirms, that the U.S. is trying to put pressure on Iran, threatening with its most important commodity, that is oil, in order to force it to achieve a certain deal. Whether they succeed or not, we have to wait and see. But what does that mean to the market? Actually, if the President Trump succeeds in achieving maximum pressure, just like what he did in his previous presidency, in his previous term, I doubt we're going to see the Iranian barrels disappearing from the market. This is a country that has been under sanctions for decades. They have mastered the skill of evading sanctions, and they have their main partner, their main buyer, that is China, that is not scared of those sanctions. So I doubt we're going to see suddenly a spike in prices going in the 80s or 90s. I don't like to predict prices, but I doubt this is going to happen. And also with in consideration that OPEC is putting barrels in the market, which can refill any gap that is left by the maximum pressure.
How sustainable then, within that context, is OPEC Plus's action, particularly the Saudis, to put more oil on the market? We lead up to the decision in June. When does the pain point come for the Saudis?
I think look, any oil producer would like to see prices going higher than the current level. But if you look at OPEC, it's a very heterogeneous organization, and members have different pain threshold when it comes to prices. Primarily, if we look at their economic dependence on oil revenue. So Iraq, which is the main cheating member within OPEC and OPEC Plus, is going to feel the bigger pain in terms of lower oil price impact on its economy than Saudi Arabia. Saudi Arabia, yes, they would like to see prices in the 80s and closer to 100 maybe, but they can sustain lower oil prices for longer. Now, they are going ahead with increasing their output in the market, primarily because of the loss of barrels from Venezuela and potential loss from Iran, but also to punish the cheaters and hopefully bring them to better compliance than what they have shown the organization so far.
Carol, good morning. Lizzie here. We had results from Shell earlier, sticking with their payouts notably, but we've got Chevron later, and they're expected to cut the buyback. BP already has. As we look ahead at the tariff impact and lower oil prices impact on this industry, how do you expect companies to make this choice? Will they prioritise shareholder returns, or do you think that they're going to have to cut spending on new projects?
I think they are going to achieve both in this respect. So definitely shareholders are their main concern. The first time we saw Shell really reversing its dividends policy was when COVID hit. So that was a major blow that made Shell reverse its position. But for companies, the main thing is that it's a long-term outlook for prices. Of course, tariffs today, they impose great uncertainty. They create lots of unknown about the future, and companies don't like that. They like to have lower policy uncertainty uncertainty because they are already dealing with market volatility. But I think if they have committed to some projects, they are going to stick with it in oil and gas. We're seeing them putting greater emphasis on oil and gas, their conventional bread and butter business, than alternative energy, primarily because they do get, I mean, it's based simple economics. You do get more economic rent from oil and gas than you do with alternative energy and green energy. So it is a rebalancing of the portfolio, which is, in my opinion, rational. It does not serve the climate agenda purpose, but it is, from a shareholder's perspective, the right policy to do to achieve the higher return that companies have been promising.
Well, are there other second-round effects for the oil majors that we should be worried about from the tariff war? I'm thinking about the steel and the aluminium tariffs.
Absolutely. I mean, the tariff story, I think 2025 will always be remembered as a tariff year, and it's not something that should be underestimated. So if you look at the various major economic forecasts for this year, within a few months, they have been significantly revised downward. So usually you would see some small revisions here and there because of corrections or barely any changes. But if you look at the IMF revisions, for example, between January this year and April this year, they knocked off several percentage points from global economic growth, from the US economy, from the Chinese economy, which are the two main pillars of global economy because they are the largest economies in the world. So you do have that effect impacting the income effect, affecting the demand for oil. And also you have the, as you mentioned, the price of steel and other material that goes into the production, the manufacturing process of the oil and gas business. So on balance, the companies will take a bigger hit if oil prices stay in this region and the tariffs are imposed, as is any other sector, I would say, in the global trade market.
Carol, what happens then when it comes to where the break-even prices are for American shale? If America, in the last, I want to say, couple of years or so, has been the #1 oil exporter around the world, what does a NYMEX price this morning of less than $60 a barrel do to that supply?
Definitely lower oil prices are not good news for U.S. shale oil and gas producers because shale is different from conventional oil. It is very responsive to changes in price. So with conventional oil, whatever we see today as production is the result of investment done many years ago. But with shale, it is the result of investment that done only a few months ago or maybe last year. So we have the sensitivity to prices is much more visible with shale oil production than you have with conventional oil elsewhere. And as such, lower prices are going to decelerate the growth in U.S. oil production. We're already seeing U.S. oil production gradually declining in response to that oil price. Now, yes, shale tends to be costlier than elsewhere. I mean, it's not a golden rule, but compared to many projects around the world, we do have a higher break-even oil price. But here I have to caution what I'm going to say with the fact that given the history of the shale in the U.S. and its resilience to significant changes in market conditions and the ability of the industry to continuously reinvent itself, I don't think we're going to see suddenly a collapse in production, but probably a deceleration of the production in the U.S., which may not allow President Trump to achieve its promise of drill, baby, drill.
Carol, to what extent is that, though, a blessing for some of these OPEC producers that are looking to regain that market share?
A short-lived blessing because they do have other, I mean, it's not something that they would like to see for a long time because increasing the market share is not going to be sudden. I mean, they are putting gradually barrels in the market, and it's not the same for all the OPEC producers. So Saudi Arabia, they may have lost some market share, but it's not a major pain. I think we will continue to see the global oil market being like the top 3 producers, US, Russia, and Saudi Arabia, maintaining their current position, and the shares are going to change up and down, up and down. For the other producers within OPEC, they either have to abide by OPEC compliance, or they have to open the tap, like the UAE, which has planned for great production capacity expansion. It will have to decide whether to sit further on those barrels or put them in the market and gain more market share. So lots of moving parts. But again, I wouldn't generalize in terms of all OPEC producers because the picture there is very divergent among members. And I'm thinking here also about the African countries within OPEC and those that are not imposed. They don't have quotas, such as Venezuela, Iran, and we shouldn't forget about Libya as well.
Fascinating conversations, and certainly three key areas that are not only susceptible to the policy out of D.C., but perhaps could help shape it. Carol Nackale, founder and CEO of Crystal Energy, we thank you so much for walking us through the dynamics in the oil market. Let's go from the energy sector to the tech sector, because coming up, it's a big earnings week for the Mag 7. It has been a big earnings week, I should say. Tariff uncertainty front and center. We're going to dive into the messages from Apple and Amazon, how that differs from the optimism out of Meta and Microsoft. That conversation next. This is Bloomberg.
.43 a.m. in London. We're heading towards the opening trade with European futures pointing high. Euro Stoxx 50 futures up 1%. FTSE 100 futures up 0.6%. But it's a better picture out of France and Germany as we head towards the open. You've got US futures also pointing higher this morning. But we've got to factor in the tech earnings. We had Apple and Amazon slumping after their latest quarterly reports failed to quell investor concerns about tech and tariffs. And speaking on an earnings call, the Amazon CEO, Andy Jassy, addressed that trade uncertainty.
None of us knows exactly where tariffs will settle or when. We haven't seen any attenuation of demand yet. To some extent, we've seen some heightened buying in certain categories that may indicate stocking up in advance of any potential tariff impact.
Now, meanwhile, Apple's China sales disappointed, and it warned of damage from the trade war. So let's put it all together. Bloomberg's Charlie Wells is with us. Charlie, just give us the context on Apple as an Amazon first.
Lizzie, what investors had been waiting for in these earnings calls were forecasts. And when those forecasts dropped, investors were not happy. So let's start with Apple. We've got this $900 million figure that I'm sure people are going to be talking about today. Tim Cook certainly was on that earnings call. This is the hit in the current quarter that Apple could take from all of these trade tensions between the United States and China. Now, China has been in focus for Apple. They have those production woes based on all of this tariff uncertainty. But you got to remember that China is also an incredibly important market for Apple as well. It's their third most important as far as sales. And Apple reported a sales slump in the prior quarter, down 2.3%. Now, this is the 7th quarter of a sales slump in China. So that's indicative of some pressure that they're having on the smartphone and the AI front. China is also important for Amazon. Let's bring up what we saw yesterday for Amazon. You know, the CEO talking about a lot of the uncertainty there. And we know that retail has come under pressure, but we also have to think about the services side of Amazon because their cloud unit is so important for the profitability here. And we saw growth in that prior quarter, but it was slower growth than in previous quarters. And now when you contrast that with Microsoft, who had a blowout earnings report yesterday, you start to see some of this competition heating up.
Charlie, I'm going to ask you to do some tech contortions now, because we've had 6 of the Mag 7 companies reporting. NVIDIA at the end of this month. The 6 that we've had, what have you learned? How has it informed us in terms of how resilient or not these companies are to the trade uncertainty?
So, Tom, when you take this bird's eye view, you see beat, 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 beat. It looks like everything is fine and well in Mag 7 land. We know that that's not the case. And we know that when you dig deeper, there has been this divergent narrative of the more software-oriented companies faring well, those that had to deal with hardware, that have to deal with retail, not faring so well in the markets. And this earnings season really helped to bolster that narrative that, you know, AI could really help propel the likes of, say, Microsoft, the likes of Meta, and that the trade war might have more of a significant impact on Amazon and Apple. That seems like these reports help that bear out.
OK, Bloomberg, Charlie Wells, we thank you. Tom, I want to pick up on a point that Charlie made here. Where you've got Apple saying that it's going to source more chips from the US, where you've got it saying that it's going to shift production somewhat from China to India, how fast does all of that happen?
Well, yeah, so they can source from the US pretty quickly. TSMC has built out those foundries and continues to build them out in the United States. And a lot of that is down to the incentives that come through from the US CHIPS Act, of course, by the Biden administration, which is now in question. Nonetheless, they can source those chips pretty quickly. In terms of the India story, that's really interesting. They have built those supply chains in India. They continue to build them out. And the production capacity out of India has accelerated at a rapid clip. And so Tim Cook was saying he can now expect to see the vast majority of iPhones that are shipped into the US markets being produced in India. And that's something that Dan Ives of Wedbush put out in his note overnight, saying this is a key offset to the risk, one of the key risks for Apple, which, of course, was its dependency on the supply chains of China. He's really confident that the story is going to work out for Tim Cook and Apple. But I think there's still a question mark there.
Well, Dan Ives also was an early warning issuer when it comes to the pricing of an iPhone. An iPhone retails for, like, I think $1,200 in the States at the moment. He was his early estimates where it would go up to something like somewhere between $3,500 to $5,000. It feels like there's been a little bit of cold water in terms of that price increase for the end consumer.
That seems very unlikely that price point's going to come through, to your point, because Apple has successfully managed to get that carve out. And as Dan says, and we can stop quoting Dan after this, but he is succinct on these tech stories. He says, look, Tim Cook is 10% politician, 90% CEO. He says maybe that's 20% politician right now, 80% CEO. He managed to carve out that loophole in terms of getting iPhone products and the hardware that Apple produces in China through without that huge tariff impact for now. But the uncertainty is still there. They have the agility. They've navigated COVID. Let's see if they can navigate this. The expectation is, of course, that there are going to be further headwinds, $900 million in terms of cost. Longer term, Apple still has a lot of questions it needs to answer, whether that's on AI or regulatory scrutiny around the services business.
Well, it's the fact that the AI space has kind of taken a back seat here because Meta was almost rewarded for showing up, for kind of catching up on the AI investment. Microsoft is still very much a player. Apple has not been. Apple has not. Their iPhones and supply chains has taken precedence over the fact that they are still behind on the AI race.
Yeah, when does Siri become a real AI product? Still a long way from that. When's the next hardware device that's going to drive revenues for Apple? We don't have that yet. When are they going to produce something in China in terms of smartphones that's going to really be attractive to the consumer there amid all of that, of course, competition? So those, again, it comes back to questions that remain unresolved for Apple.
Certainly something we're going to be keeping a very, very close eye on as we get this kind of early tech reads on what these trade policies may actually mean for the ultimate corporate earnings story. And it's just one earnings quarter just yet, married, I should say, with a drop in GDP growth. The other data point we're keeping our eye on this morning is going to be those U.S. non-farm payrolls later today. Let's go to Paul Dobson, our executive editor for Asian markets, joining us for our daily 3 minutes. Paul, I'm still confused by the definition of a recession that we're all using here. If we're talking about 2 negative quarters of growth, which again, we've got 1 negative quarter in the books for the United States just this week, do the layoffs mean anything right now? Do the payrolls numbers mean anything right now when analyzing this macro data?
Good morning, Kriti. I don't need 3 minutes to have the run-through of markets today. And before we dive into what you just said, there's only one thing that really people are caring about right now, and that is that the trade talks are on and making progress. And so everything is looking forwards rather than looking backwards. And that's the difficulty that we have right now when we're assessing everything that you're talking about, be it the tech earnings, be it the non-farm payrolls, be it the outlook for the economy. I think, what people are worried about is that trade-off between inflation versus the hit on the economy. We're certainly seeing the soft data pointing to a rapid slowdown in the US, but it could all be unwound pretty quickly if there is a trade deal and flows start to come through again, if the tariffs aren't as big and excessive and troublesome as the market had initially priced in. And so that's why, every sign that there's a little bit of a clawback in terms of the tariff conversation, the market takes this as a positive and we continue to push on higher. So with all of those economic worries still hanging over us, all the same, trade talks is what really matters here.
Well, you bring up the trade talks. What about Japan's finance minister threatening to use these US Treasury holdings as a bargaining stick in their negotiations with Donald Trump? I mean, it's a big stick to wave, but how seriously do you take it?
I think it's really interesting that it wasn't instantly dismissed, Lizzie. I think that the context of those comments is important as well, though. It was in response to a question, and the reply was, well, it is a card, it is something that could be in play, but it's not something that it seems like it's particularly there at the moment. And we don't know. Is Japan using it as a bargaining chip? Could the US be using it as a bargaining chip? We saw in the Mirren documents the idea that they want more people to commit to sort of long-term funding of the US through these sort of zero-coupon perpetual bonds or something like that. Maybe it's the US that wants the Treasuries to be discussed, not so much Japan, but it's that sort of two-way sword. Interesting thing, I guess, is that it wasn't instantly dismissed. So mentioning that does let the genie out of the bottle and got the market very excited about it today.
Paul, what's going to be keeping you and the team busy next week?
still the tariff talks. I mean, look at some of the moves today and just think about what's going on, right? Asia FX is having an absolutely gigantic day. The Taiwan dollar up more than 3%. It's really a gigantic move.
Yeah.
You know, we have things like changes of government and politicians resigning in South Korea. Market doesn't care. Market goes up because trade talks are on. You know, you have all the brinkmanship in India and Pakistan. Market doesn't care. Market goes up. Trade talks are on. All around our region, you know, any sort of consternation, any sort of political machinations, any worries about the economy, doesn't matter. People are looking forwards. If the US and China can get some kind of a trade deal, everybody can breathe a sigh of relief and get back to normal. And those fundamentals, which are reasonable all the same, even with every cloud hanging over us at the moment. So all about those trade talks, Guy.
I think I might be right. I think Paul was suggesting that the trade talks are central for the market. I might be wrong. I might have missed something. Paul Dobson, Bloomberg's Asia Markets Executive Editor. Fantastic. Thank you, Paul. Have a great weekend. You and the team. Paul Dobson, of course. And remember, you can get up-to-date analysis and insight at MLiveGo from Paul and that fantastic team, of course, on your terminal.
I think it's fascinating that he was saying that in response to Lizzy's question for the Japan piece, is that it might actually be more beneficial, more in the interest of the United States in terms of using that tool rather than Japan. I think that's really fascinating. I haven't heard anyone have that take before, that the U.S., that actually may be in the interest of the U.S. in terms of supply and digestibility when it comes to those holdings.
And you can't talk about Japan's sovereign debt holdings and a potential leverage point without talking about China's sovereign debt holdings of the U.S., of course, and whether that comes up in the talks. And I think that is the context, all of that granularity, all of that detail. These are markets that seem desperate for that good news on trade. Just a hint, as Lizzy was saying, of a hint of possible talks, and we're latching onto that. But there is so much to overcome before you get to something substantial between Beijing and Washington, but so far they're liking the rhetoric and the mood music on trade.
Yeah, look, Japan looking for a deal by June, but really all the focus on China. How much does it matter what anyone else can achieve unless you get that deal with Beijing and Washington? Up next, the opening trade. Stay with us.
We are a few minutes to go until the opening trade across Europe. Remember, the European markets were closed yesterday, so what the Stoxx 600 did 2 days ago doesn't matter as much as what the U.S. market did yesterday. And this is a futures picture that I think really captures perhaps the sentiment and the catch-up trade you may see at the open today. Over the last 2 days, it has been nothing but green on the screen. A slight blip in yesterday's session, only to get pared back when it comes to the futures trading. Lizzy, how does this set us up for Europe?
Well, as you say, Europe on holiday yesterday, Kriti, but today futures are pointing up 1.1%. Weakness on the FTSE, that was trading yesterday, but FTSE futures up 0.5%. Better picture as we look to France. The trade optimism feeding in, Tom, but lots of earnings to factor in as well. Which stocks are you watching?
A couple of banks, one oil major, of course, Shell coming through. They've come through with $3.5 billion in terms of the buyback. This despite, of course, the softer oil environment they've been working through as well. So in terms of adjusted profit for Shell, keep an eye on that one. That was a beat in terms of the first quarter, $5.6 billion. And again, the buyback could propel that stock at the open, but concerns longer term about the softness around oil. NatWest saying there's relative resilience in terms of the consumer here and the customer. They come through with a beat as well, so watch that stock. Provisions, though, being raised for NatWest as they were at Lloyd's. And Standard Chartered also continuing to commit to their buyback plan for 2026, benefiting in terms of the markets unit from volatility. But, of course, the trade tariff overhang could be there for Standard Chartered going forward. So far, that was a beat for Standard Chartered, so watch that stock as well.
Certainly something that we're going to be keeping a very, very close eye on. And you mentioned the key companies there. Well, the energy sector does actually kind of maybe have the bulk of the moves today. Remember, yesterday, as Lizzy was mentioning, Europe was closed, so a catch-up trade baked into the indices as well, especially when it comes to some of the banking story. I've got my eye on BBVA, among others. Does the trade story actually show up on a day that has been sandwiched between a bank holiday in Europe and, of course, a weekend here in the UK, and I should say around the world as well? Let's talk about the open. It is here now. We are seeing green on the screen right off the bat from the FTSE 100, virtually flat at the moment, but edging into the green. Let's see whether that catch-up trade Lizzy was talking about actually manifests when it comes to the actual opens across Europe. We're looking at a FTSE 100 trading at circa 85.45 at the moment. There's the Stoxx 600, and there are those monumental moves. You can see the periphery outperforming right out of the gate. IBEX higher by about 1%. The Stoxx 600 as a whole higher by 0.6%. Tom, Lizzy, may take a minute for the CAC, and there's the CAC higher by 1.5%. That is a massive move to the upside. The catch-up trade already showing up. How is this shaking up on an individual basis, Lizzy?
Well, if you look at some of those individual stock movers, then we have Shell currently up 2.5%. As you say, they've stuck with their payouts and their spending plans despite the drop in the oil prices. And then as we look to the sectoral breakdown, you've got energy about, a quarter of the way down the basket, 7 position. So it's 2 sectors in negative territory, but the rest in the positive, led by basic resources, up 2.2%. And if we go back to some of those single stocks, you mentioned, Tom, NatWest, saying their customers are resilient amid all of this uncertainty, and those shares also up 3.5%. Standard Chartered, you spoke to their CFO, they had earnings as well, they're up 2.1%, their profit beating. Danske Bank reporting, we'll speak to them later, but they kept their full-year net income forecast, and those shares up 3.2%. So a lot of green on the screen for some of these earning reporters.
Yeah, NatWest coming through, of course, with pre-tax income in terms of the top line for the latest earnings, up 38%, still seeing resilience. Net interest income as well, a positive for NatWest in a different rate environment versus Standard Chartered. Standard Chartered seeing a slightly different picture. UBS guiding for softer, earlier this week, guiding for softer net interest income through the week. Again, across your sectors, as Lizzy was saying, top line, basic resources outperforming up 2.5%, followed by industrials and banks. On the downside, utilities, real estate and media seeing a little bit of softness and otherwise very bright picture for European equities.
Yeah, broad gains across the board. I think I'm really kind of struck by how you're seeing the energy sector and the tech sector kind of leading the rally here. Those are usually two sectors that kind of move in terms of opposite directions. This morning, it seems healthcare certainly on the back foot. It's a crucial time, of course, as we see. It is very much a catch-up trade. You are likely to see a little bit of low volume, a little less liquidity as well. Let's getting in a true expert here when it comes to these markets. Ronald Temple, Chief Market Strategist over at Lazard, joining us around the table. Thank you for coming to visit us.
Pleasure.
We appreciate your trips to London. Green on the screen, as Tom and Lizzy were just outlining there, which means I have to put on my bearish hat, and as I must. Ron, walk us through where the red flag in this market is. If we're talking about recession calls from all the Wall Street banks, we saw the contraction in GDP this week, at least for that one quarter. Where is the concern for the next leg lower when it comes to equities? Is it buyback suspension? Is it widespread layoffs? Two things we haven't yet seen while we've seen a contraction in GDP.
Right. I think, point number one is it's just too early to see the effects of the trade war in macro data or earnings. I think a lot of people have basically gotten relief from seeing, when you looked at the GDP number this week in the U.S., final sales to private domestic purchasers were up 3%. So it was a good number. So I would look past that 30 basis point decline in GDP. But the reality is that's GDP for the first quarter before these tariffs really went into place. And looking for companies to give guidance, I think, is a misplaced idea as well, because a lot of the companies don't know what to give guidance on. They don't know where the tariffs are going to end up. And so it's impossible for them to look into their crystal ball and tell you what to expect. So what I'm thinking is you need to just step back for a moment, ignore the day-to-day headlines about whether China might be preparing to negotiate, and focus on the fact that on January 19th, the weighted average tariff on imports of goods into the United States was 2.7%. Today, it is 10 times that level at 28%. That is a huge shock to trade, and over time, that will translate to higher inflation, higher unemployment, lower GDP growth, and lower corporate profitability. And so I think we have to look ahead and think about second quarter earnings season when companies might be able to give more guidance, and look at the macro data that's going to be coming in June and July, not this week.
But does the macro data even matter, I guess is my point, if it's not met with real contraction in the operations of some of these companies? We've had experts around the table talk about pullbacks in CapEx spending, pullbacks in hiring, pullbacks in buybacks or guidance, for example. And to your point, I hear you on the buybacks and the guidance bit. No one really has a crystal ball. But the actual contraction that people are talking about in terms of corporate specifically, that doesn't seem to be coming as quickly as perhaps anticipated 3 months ago.
No, and I think it's going to take time. Again, imagine you're a company that imports inputs from China, and about 40% of all U.S. imports are inputs into other goods. You knew there were going to be tariffs on China. The president campaigned on this for the last year, talking about 60% tariffs. So you probably front-loaded your inventories. You're running down. You're going to deplete that inventory of low-cost inputs, and at some point you're going to have to replace it with much higher cost. I think that's when the rubber hits the road, and you start to see companies deciding, how much can I raise the price to my end customer and how much headcount do I have to cut to basically try to mitigate some of this pricing pressure. And so I'm thinking you're going to see this in the May employment report that we get in June. I think you're going to see it. We probably, in 2 weeks when we get the next CPI report in the U.S., I think that will be the trough of inflation. Thereafter, I think you see inflation start to reaccelerate. And that's why I mentioned second quarter earnings season is when you're really going to start to see companies having to make tough calls. Now, by the way, between here and there are a lot of headlines, right? We're all waiting for July 9th when the 90-day pause on reciprocal tariffs will end. But I think basically you should keep your eyes fixed on that 28% weighted average tariff. Simple rule of thumb, every 1% increase in the weighted average tariff equates to 10 basis points of core inflation. So right now we have about 250 basis points of extra inflation in the pipeline. Substitution effects will work some of that down, right? Imagine there's a 100% tariff on textiles from China and a 10% tariff on Bangladesh. You find a way to shift Bangladesh. Over time, that 28 will probably come down to 20, but still a lot of extra inflation.
So what I'm hearing from you is that stagflation is on the cards,
yes,
which would leave the Fed with its hands tied. How confident can we be in the Fed put then?
I am 100% with you on that comment. Stagflation is basically my base case scenario right now. Even in the best case outcome, where we have a 10% universal tariff on all trade counterparties except for China, which is maybe at 20%, and you have sectoral tariffs, steel, aluminum, autos at 25%, you basically end up with core CPI at the end of this year around 4%, and growth probably closer to 1.5%. So not a great outcome. And the market is saying, as of this morning, 90 basis points of Fed rate cuts by the end of the year. I think it's zero. So I think there's too much optimism around the Fed. I think the Fed is going to have a very hard time basically cutting rates when inflation is accelerating that much. And so I think that's part of the risk to the market as well, beyond the buybacks and the guidance.
Wow. So how much of a correction in equities are you seeing if, and I know there's so much uncertainty, all of your assumptions come true?
In the best case, we're where we are today at the end of the year. But I worry that in the middle, I mean, I have three scenarios I really track. In the middle scenario, I think easily 10 to 15% downside. In the bad scenario, there could be 25 to 30% downside.
Ron, Kriti started by saying she needed to wear the bear cap.
I know. Now I'm like, now I have to like.
I think I just grabbed your hat. Sorry, but yeah.
You're pulling it firmly over your eyes.
Well, and again, I'm just trying to say these are the fundamentals of the operating backdrop right now. So it's great that we had the pause to delay until July 9th. We need more than a pause. We need these tariffs to come back down.
Let me give you a counter then. The markets, the Trump administration has proven to be vulnerable to the markets. They're going to adjust around that. We know there's sensitivity. We know there is discontent within the Trump administration about how the tariff policy has been unfolded, unlike other parts of the policy administration. The Fed, they're going to go soft on labour. They're going to have to make a move. They're going to have to cut because the labour market is going to start to soften, as you say. Some kind of traction is going to come through on the deal front. Earnings per share, earnings across the board in terms of the numbers that come through so far, up about 13%. There's a resilience across US corporates. There's a risk that with all the cash sitting on the sidelines, you take this bearish view and you're sitting on the sidelines and some of these deals come through, you get caught short.
I recognize the risk. By the way, I think you just sketched out the sentiment I see in the market, which is a fear of missing out. I mean, I literally have clients asking me, have I already missed the opportunity to put money to work? Is it all over? I'm like, no, the news hasn't even really started to show up. And so I think what you're pointing out is you absolutely don't want to step out of markets altogether. You need to be selective on your investments. I think valuations matter. The U.S. is not the only market. I think what a lot of global investors are realizing is the gap in valuation between the S&P 500, which was at 22, 23 times, now we're at 20 to 21, versus Europe at 14 times, Japan at 14, EM at an even lower multiple. There are choices in the market where you might be able to get better opportunities. So I think part one is identifying where you want to be invested. Part two, though, is recognizing at some points the market gets overextended, excuse me, and you want to take some money off the table.
Where do you go in Europe, then? Where are you finding margin resilience in that trade tariff scenario in Europe?
You know, I think Europe actually has some really... I've never been a big fan of having a Europe allocation because there are certain parts of Europe, certain sectors where you get great companies and other sectors, let's be honest, where you don't have a lot of choices. And so I think in Europe, you've got some of the best consumer companies in the world. You've got some of the best industrial companies in the world. The UK has some great opportunities. So again, it's going to be a mixed bag in there, but I think that's where the security selection really comes into play, and it's company by company.
All right, outfit change. Back to my bull cap here. The argument against all of this doom and gloom, basically, is that the system has way more liquidity in it than it ever has, even with the sell-offs, even with foreign buying coming down. It actually has too much liquidity that could arguably diminish the need for a Fed put at the end of the day. That's what moved the market post-COVID with the help of the Fed. Doesn't need the Fed this time around because there's so much still in the front end of the curve in money markets, et cetera. Could the extra liquidity in the system function or help the market function kind of like a floating device?
Well, forgive me for this. I want to go back to something Tom said before I answer that, because back to the administration's sensitivity to markets. I think the administration proved it's sensitive to the bond market, not the equity market, right? A lot of us were discussing a Fed put, a Trump put, all these different puts. The reality is when we had that combination of the equity market selling off and the bond market and the dollar, that's when the administration pulled back. And because of that sensitivity, I think my worst case scenario is unlikely. I just plotted out those three scenarios. So I don't think the 25 to 30% downside is what we're going to see. I think what we're going to see is an administration that basically watches what the markets are doing and periodically pulls back or offers the good news to rein us back in from this negativity. So I think they've done a pretty good job of it so far, by the way, considering how much tariffs have gone up, that the S&P is only down 9% from the all-time high. Not about outcome. Yes, there's also a lot of liquidity in the market. And very importantly, even in my bearish case scenario, recession is not a slam dunk. I think you're debating recession if the weighted average tariff ends up being somewhere around the current levels. My concern, though, is in recession, earnings are not up 10%, they're down. And so that's part of where the downside comes from, is earnings risk and PE multiple compression risk. Luckily, entering this year, the U.S. economy was so strong, the corporate balance sheets were so strong, consumer balance sheets were strong. I think that's unlikely. So, again, I don't want to sound doom and gloom. I know I took your hat away. I want to give your hat back. You can be the bear. But I think people need to be more realistic about what the environment is for companies and recognize you're not going to hear the bad news this week. It's going to happen over the next several months.
Can I just come back to Europe? I'm still processing that you don't see any Fed cuts this year, but the market's fully pricing in 4 Bank of England rate cuts this year. So if you have that situation, and by the way, inflation might be sticky, right? So I wonder if that's realistic for you, but where would it leave the pound?
Actually, I'm expecting 4 rate cuts from the BOE. I think the BOE will deliver on those expectations. I think the ECB
How does the BOE cut 4 times if the Fed's on hold through the year?
Because the BOE
We're
has
so closely linked.
I think what you're going to see is declining inflation in the UK. But again, keep in mind,
because of imports?
The UK did not put a 25% tariff on everything they import, right? The UK has declining inflation. It's not necessarily mechanically attached to the U.S. And I think when you look at the UK and the Eurozone, you're going to see weaker growth because of what the U.S. is doing in terms of raising tariffs on their exports to the U.S. that gives them more latitude. I mean, by the way, let's zoom back out for a minute. The Eurozone has had better success on a nice, smooth decline in inflation relative to the U.S. The UK clearly has had a stickier service inflation that's been more worrisome. What we're seeing more recently in the UK is easing in the labor market tightness, easing in that service inflation in the last couple of months, better than expected data there. I think that's going to continue. In the Eurozone, I think the pressure from U.S. trade policy is going to accelerate the decline in inflation, giving the ECB more latitude to cut. And so this has basically been my set of expectations since the beginning of the year, is no Fed rate cuts and more rate cuts from non-U.S. central banks than people expected. P.S. I had expected that to translate into a stronger U.S. dollar. That clearly did not happen. But I think you actually could see another leg up in the dollar as these divergences are magnified.
Ron Temple, Chief Market Strategist at Lazard, walking us through, I feel like, a bull case and the bear case. We covered a lot with you, every possible scenario. We thank you so much for joining us around the table this morning. As we're about 15 minutes into the trading session here in Europe, let's take a quick look at the core 6, basically the mega cap companies that tend to move this market the most. And this is, I think, a great example of a risk-on kind of day, even if it is amid some light liquidity, a little bit of a catch-up trade given Europe was off yesterday as well. Gains across the board. LVMH higher by 1% despite a cut over at Barclays to equal weight as well, and a price target cut as well. Nestle, which is, of course, that favorite consumer staple, a defensive play, if you will, actually down on the day. Novo Nordisk, again, which is traditionally tends to, or at least in the last couple of weeks, has taken quite the leg lower, higher by 1.7%. Even Schneider Electric and ASML catching some of the positivity in the tech bid, despite the somewhat negative earnings from Apple and Amazon. So that is a picture of the core 6.
Kind of underscores what Ron Temple was telling us about picking your points within the European market, doesn't it? Coming up, NatWest and Standard Chartered shares up at the start of the European Open after reporting positive results. We're going to wrap up this week's UK bank earnings. Top line has been positive. Stay with us. This is Bloomberg. Standard Chartered shares up this morning after the lender reported first quarter profit that beat estimates. There you can see the gain of 1.2%, driven by its wealth and financial markets units, the volatility benefiting that part of the business. The lender has stuck as well to a plan to return at least $8 billion to shareholders from 2024 to 2026. The company's CFO, Diego Di Giorgio, spoke to me earlier about those numbers.
Are doing a lot of things in the short term. There is a lot of tactical activity. There is a lot of repositioning. There is a lot of taking care of exposures, whether it's to rates, to currencies, to commodities, as you mentioned before. And therefore, that activity is very high in the current volatile environment. And then the clients are evaluating what to do strategically going forward. And for that, we will have to see how the current uncertainty evolves and hopefully continues to abate. For them to decide to put in place more strategic activity.
Does that pace of activity, is that likely to be sustained?
So the pace is high now. This is an environment that changes every day. So it's clear that there is a question. But the long-term drivers of it remain very intact, and particularly in the wealth management business. Our type of wealth management, while we are active all across the wealth management spectrum, we are particularly focused on affluent customers. And affluent customers are really long-term savers. They have bancassurance products with us, mortgages, some funds, and we see that they are shifting toward more defensive products, but they remain active.
You're helping your clients. The volatility is a benefit. They come to you for that assistance. How do you compete? How do you balance that versus the competition of possibly a slowdown in trade volumes as a result of the uncertainty? Does one offset the other?
So, first of all, let's put into perspective that what we are really is we are a giant connector bank between our fast-growing regions in Asia, the Middle East and Africa and the rest of the world. Trade is important as an activity, but it's less than 5% of the revenues of the bank overall. So what we are really focused on is on, as you say, making sure that our clients continue to adjust either their financial lives, if they are wealth management clients, or really continue to diversify their supply chain. An activity that they have been doing for years, but that has clearly accelerated.
How much cross-border revenue, though, do you think is potentially at risk as you look out?
So we have, in our results for this quarter, we've tried to be helpful to our investors and to our shareholders in explaining a little bit how our exposure across the network works. The reality is that our network is so diversified. The 175 years of investments and the 53 countries we operate in mean that the shifts are really shifts in direction. But the overall growth of the fastest regions of the world remains a structural trend that remains very powerful.
Are you seeing money flows moving? Are you seeing money flows moving in a substantial way out of the US to other jurisdictions?
Very interesting. We have asked ourselves this question and we've looked. We don't see evidence of a real asset reallocation away from the US or away from the dollar. We are seeing it mostly, as I said, in the nature of the investments. The investments in the short term are becoming more defensive.
OK, Standard Chartered's Group CFO, Diego Di Giorgio, speaking to me earlier on the back of those earnings that, of course, came through the beat and the stock up so far in the session. Let's get more on the UK bank earnings, bringing the analysis as well in terms of what we've been seeing with NatWest, Lloyds earlier this week. Standard Chartered, of course, reporting this morning. Very pleased to say Tom Metcalf, Bloomberg's managing editor of EMEA Finance and Investing, joins us now. What were the standouts then in today's earnings for you and the team, Tom?
Yeah, look, I think for Standard Chartered, it's that wealth bit of their business, and I think one of the stats was something like 13 billion of new inflows this quarter for their wealthy clients. And as you could hear the CFO saying there, that's been a very important sort of driver of what's a pretty strong quarter. And then I'd actually pick up something he said in that interview with you is, you know, this elevated trading activity. He's saying that's still happening because that's the biggest question for any, you know, bank with a big investment banking sort of side is how long can this volatility continue to benefit? And, you know, the UBS CEO saying, gosh, the start of April was absolutely mental, but then it's kind of calmed down a bit. But interesting to hear the CFO say that's sort of still sustaining, which you would think would be good news for as long as that can stay along for those trading banks.
Put that into context in some of the other earnings we got this week.
Yeah, I think it's a part of a piece of what we saw with Barclays, with Deutsche. The trading floors are absolutely chocker in terms of business and volume, and that's really helpful. The question is, how long does it last for? But broadly speaking, you saw it with NatWest again today. You know, it's been a strong first quarter for all these banks. So it's this fascinating sort of push and pull of, hey, look, we can reaffirm our guidance. In the case of NatWest, they actually said we think we'll probably hit the upper range of our guidance in 2025. But then you just have this massive unknown of, it's still too early to know how the sort of tariffs play out, how does the sort of those trade flows change. So it's just really difficult, to put too much stock into what has, broadly speaking, been a pretty positive quarter.
Tom, you've got more change at the top of HSBC. The AGM today with Mark Tucker, but we heard yesterday he's going to retire. He's had 8 years in the chair, 4 CEOs, 2 major restructurings. How do they replace him? What do we expect out of the AGM? Yeah,
it was a fascinating day yesterday. He really is, for me, sort of the defining figure for HSBC over his tenure. And it'll be interesting to see what they look for. He was the first outsider as a chairman of HSBC. Do they continue with that? And, of course, whoever they pick, they've got a new CEO in line. So it'll be an interesting role to fill. But they're saying they're going to fill it by the end of the year. So that, to me, suggests a big role like that. They've got a few candidates in mind. And, if you're asking from my sense of things, I think they'll go for another outsider.
OK, interesting call. You're looking at HSBC shares this morning, up 1.3% in London, but up 12% over his tenure. So we look ahead to that AGM. Bloomberg's Tom Metcalf, we thank you. Let's check on some of the individual stocks that are on the move at the open. Just focusing in on some of the other banks that have been reporting this morning. So you've got ING shares up 4%. It topped its estimates. It's issued a fresh share buyback. But at the same time, it's pushed out its capital goal because of the tariff uncertainty. So interesting to see that the shares are up so much. And then Danske Bank reporting this morning as well. Those shares up more than 3%. It kept its full-year net income forecast. And in general, the first quarter beating estimates. So a positive read on the market on Danske Bank. But they're not the only ones reporting this morning, Kriti.
No, not at all. There are plenty of earnings that we are keeping an eye on in terms of the energy sector later in the States as well. But right here in Europe, Shell, of course, higher by 2.8%. Their adjusted profit beating estimates, though, even though some of their margins are seeing a little bit of pressure. They're also launching a $3.5 billion share buyback. So that's always going to kind of inject a little bit of optimism into the stock as well. Something you're seeing in the likes of Schneider Electric and Siemens Energy as well.
On the tech front, this also may be partly a catch-up story to the US tech earnings earlier in the week. Of course, Apple and Amazon have muddied the picture a little bit, but European tech is performing very strongly so far in the session, particularly in terms of semiconductors, and a number of those names listed in the Netherlands. So BE Semiconductor is leading the gains, up 4.4%, but of course ASML as well, those makers of the lithography machines that go into the foundries of TSMC and others, currently up 2.6%. So a decent session for tech. There's the other potential catalyst, which is the reporting around a potential carve-out for NVIDIA chips being sold into the UAE. And, of course, discussions may be starting between the US and China. So a number of those potential catalysts feeding in, it seems, to some upside for tech this morning in Europe.
Yeah, trade optimism adding to the green on the screen that we are seeing this morning. But coming up on the programme, the European Union is set to present its own trade proposal to the US negotiators. So we'll dive into that next. This is Bloomberg.
This is the opening trade. Happy Friday, everyone. We are 30 minutes into today's session, and you are seeing a bright picture again. Set for 8 straight days of gains, if things hold, of course, across European equities, potentially 9 straight days of gains for the US. The earnings optimism there, certainly as well, the rhetoric around trade, and at least in terms of the needle moving on some of these conversations, seeming to play into the upside that we're seeing across the equity markets. So the benchmark here in Europe currently up 0.9%. I'm squinting at the screen. The DAX in Germany up 1.4%. And in terms of what's happening here in the UK, the FTSE 100 as well, benefiting from the outside coming through from the likes of NatWest in the banking space. Energy also performing well. Basic Resources giving a lift to the FTSE 100, currently up 0.8%.
Let's talk about what we might expect in the next coming weeks. Of course, the current state of play and tariffs very much in focus and driving some of the optimism, as Tom pointed out. The EU planning to share a paper with the United States next week, setting out a package of proposals to kickstart trade negotiations with Donald Trump's administration. Now, joining us now, Bloomberg's Kevin Whitelaw on sabbatical, hiatus, or visiting from Brussels, whatever you might want to call it. Walk us through kind of what that relationship may look like. We've previously heard that natural gas has been a key piece of this conversation. I think Ursula von der Leyen had used the phrase that they're knocking on a door that is swung wide open already. Walk us through what else the EU can offer that Donald Trump would want.
I mean, the EU is in the process of trying to figure out what that actually is. And I think the problem is they know there's a handful of things they could offer, and it's not clear the U.S. is interested. So that may come with, this sort of what they've called zero for zero tariffs, reducing all tariffs to zero. But so far, they talked about that with the U.S. in previous years. They talked about that with Trump 1. That wasn't really enough. Trump has talked a lot about non-tariff barriers, and so there may be some room on a couple of those, but a lot of those, like the value-added tax, are simply non-negotiable for the EU. So they are putting together a package. They're trying to come up with something that looks impressive, and it's just not clear whether or not it's going to make any difference for what Trump's actually looking for.
Well, so if that 10% is a minimum tariff, what happens if there is no deal?
Well, if there's no deal, it goes back up to 20% at some point. That's sort of what Trump has set in motion. The EU obviously had imposed some of its own retaliation, paused that. So at some point, there's either going to be some kind of a deal or it goes back. But there is a growing sense in the EU that we're looking at 10% is the minimum. That's not going to be negotiated away. And it's not really clear that these various sectoral tariffs, the car tariffs, the steel tariffs, the aluminum tariffs, it's not clear those are going to be able to be negotiated away either. So there's already a new normal. The EU is going to have to respond to that in some fashion. And then, of course, that could trigger another Trump reaction. So even if there's a deal, it's not really clear how much it's going to mitigate for the tariff side.
Kevin, is the domestic pressure on Trump more acute when it comes to the China story? Because there's a very direct link between the shelves in Walmart and Costco versus Europe and a BMW or a luxury handbag?
Well, I think the pressure is right now steeper because of China, in part because of the kinds of products, but also just because the tariffs are so incredibly high. So you're looking at something that's making trade simply unsustainable, and that's going to lead to massive shortages, as opposed to just cost increases that may take a little while to be noticed. But it is going to still take a little while, but not very long, for some of those things to be noticed. And what's really not clear then is what kind of pressure that's going to put on Trump. But once Americans go into stores, see shelves empty, see prices on things that they simply can't afford, that is going to put pressure on Trump, in large part because it's going to put pressure on Republicans in Congress. They're all going to be seeking re-election, relatively soon, and everyone's going to know who to blame for those shortages and those price increases.
Back-to-school shopping seems to be the key piece where that may show up. You're already seeing a lot of the shippers talk about these imports that they bring in for not just back-to-school shopping in August, but, of course, the holiday shopping and holiday season at the end of the year as well. All that shipping is halted, and you can see that in some of the cargo routes as well. Walk us through just how much kind of the domestic concerns outside of some of the tariff and the price increases could move Donald Trump's position.
Well, I mean, ultimately, again, it's going to be that thing where when Americans want to go and whether it's get their school supplies, get toys for their kids, get whatever these products are, there's going to be products that people need, hairbrushes, I don't know, whatever it's going to be. There's going to be points where these things simply get too expensive or just aren't available because nobody can do it. And again, there's nobody else to blame. Who can Trump deflect? He can't blame
So the Trump administration, to that argument, would argue that a decline in oil prices, for example, would offset some of the pressures you see in other places. To what extent is that a viable argument?
I mean, to the degree that Trump owes his victory in the election, in part to the fact that prices were increasing on eggs and other products in the U.S., the fact that we were lower in some areas didn't make a difference, right? That Americans are looking at the prices that they're spending in their pocketbook. They're looking at the things that they're spending every day. That's what they're going to care about. And they haven't seen the kind of price relief that Donald Trump had promised, and in fact, they're going to see the opposite. And in some ways, I think the shortages may be even more psychologically damaging to Trump than even the prices, because that's going to sort of bring people back to those COVID days where we're scrambling to try to find toilet paper somewhere.
Well, Kevin, you're joining us from Brussels this morning, or on a visit from Brussels this morning, and I'm curious about the European Union's maybe if they're kind of gearing up for this negotiation and this battle with the United States. Has that changed their position when it comes to their approach to China? Just a couple of months ago, they were so tough on the EU kind of cars and overcapacity conversation, and it feels like the narrative has shifted a little bit.
Yeah, I mean, I think that there's at least some willingness to understand that inside the EU that they have to be working on trade relationships with other partners, and so you're seeing that a lot of outreach, in particular to places in whether it's the Mercosur countries in Latin America, whether it's India, whether it's countries in those kinds of elsewhere. The problem is the EU is a rules-based trading system, and that's now what they actually see as their greatest strength, particularly as Trump tries to tear up the trade rule book and just sort of throw things out. The EU's marketing pitch is we're a predictable rules-based trading system. That doesn't go quite so well with China, with the way that they have been sort of carrying out some of the trade and some of their practices with subsidies and everything else. So yes, there's an openness to it, but there's an enormous skepticism that there's going to be some massive renaissance in trading relationships with China, because I think the EU is saying we can go the other way from Trump and really show people why they should do business with us.
It's interesting because where you're talking about this warming of relations between the EU and China, actually from the UK's perspective on China, you've seen Rachel Reeves echoing the Trumpian view on China and criticising the trade imbalances. So you've got to see how that EU-UK relationship plans out when you've got the US and China to factor in as well. Kevin Whitelaw, we thank you for your analysis en route from Brussels to Washington. But let's go to Washington next. Since Donald Trump returned to the White House, Elon Musk's been an absolute scene stealer, gutting government agencies and sparking litigation too. But Doge hasn't fully lived up to its billing, while Tesla has become collateral damage. That's the topic of our weekly doc.
The marriage of money and power is nothing new, but the arrangement between billionaire Elon Musk and President Donald Trump is like no other in the history of U.S. politics.
Come on up here, Elon. They're buddies. That's probably a good description, at least how Elon Musk sees it.
Donald Trump needs his fall guy, but he also needs the bulldogs, and sometimes they're the same person.
It's been a crazy 100 days.
You look around the U.S. government right now and you see friends and allies of Elon Musk in all these various departments, in all these various top leadership roles.
Trump has been able to get Elon Musk to help propel through all the changes that were spelled out in Project 2025, a blueprint for reshaping the government.
In Doge's mind, they have been wildly successful. And on the flip side, there is a cost to laying off federal workers, to fighting all of this litigation in court.
Musk is known for his uncanny ability to play a long game, but he may not have expected so much public blowback.
So Tesla's sales really dropped. Their first quarter sales were 13% lower than the quarter a year ago.
Starting in May, my time allocation to Doge will drop significantly.
As Musk pivots, the struggles surrounding Doge's actions continue, while many Americans are reeling from a tumultuous 100 days.
Musk isn't really leaving the Trump administration.
It's not like Doge is ending. I mean, Doge is a project that's supposed to continue until July 2026.
One thing we've learned over this last 100 days is that there is going to be a huge cost to Elon Musk for doing the things he's doing. He has basically taken his personal brand and tarnished it. And that's what happens when you put yourself front and center of some extremely controversial and often unpopular policies.
Of course, you can catch that full documentary from our very own Bloomberg Originals team. It will be available online on the Bloomberg terminal. Really fascinating reporting from our team across the United States. But of course, it is that key risk that you were seeing, not just in the tariff uncertainty, but the domestic politics as well, that are scaring a little bit of corporates, of course, locally in the U.S., locally in Europe, but as high as the Nordics as well. That has been one line that's come out of Danske Bank this morning, despite a slew of positive earnings. The shares are, of course, higher at the start of European trading to the tune of about 3%. As I said, those market jitters, a lot of it emanating from Washington, D.C., has impacted Denmark's largest lender in their first quarter. Let's go now to an exclusive interview with the CEO of Danske Bank itself. Carsten Eggeris joins the program this morning. Carsten, a pleasure to have you. Thank you so much for making the time for us. Just walk us through these numbers here and put into context about how sustainable these numbers are in the face of some of that geopolitical risk.
Thanks a lot. Good morning. Thanks for having me. Look, first of all, we're pleased with the first quarter. We see year-on-year good activity across our markets and across the Nordic economies more generally. And I think, as you asked, sort of, how does that play out in the context of market jitters and concerns about trade war? I think importantly to say that the Nordic economies are standing strong. And if you look at Denmark, we saw close to 4% growth in 2024. We continue to believe that we'll see more than 3% growth in Denmark as we look into 25, despite downwards revisions. And, if you look at the trade relationship with the U.S., which of course is important, when you look at direct trade, which is really encompassed by potential tariffs, it's relatively manageable. It's around 2% of GDP. So yes, of course, customers are concerned navigating difficult environment with this restructuring of global trade. But at the same time, it's a trend that has, of course, been underway for some time and that companies have been able to navigate in. Some customers clearly harder hit than others. But I think the other thing I would add in there is some optimism around Europe, increasing optimism about Europe, right? Both normalization of inflation, lower interest rates, reallocation, which we've also seen from some of our customers from U.S. equities into European equities, and also a sense that there is increased focus on Europe, on growth, more spending, all of which will offset some of the uncertainties around the restructuring of trade.
Well, Carsten, is that increased exposure to Europe from the average international investor enough? Is the margin of that enough, or the volume of that enough to offset declining interest rates, as you put it, when it comes to the profitability of your bank?
Yeah, I think there are several things in play. First of all, we do believe that as inflation normalizes, interest rates come down, that will increase the likelihood of investments, of spending. Cheaper financing costs, I think, is generally a good thing for our customers and our clients. But also the commitment from European governments to spend more on infrastructure, on the green transition, on defense, those kind of things will also help underpin activity. Clearly, the restructuring of global trade will also cause and necessitate corporate clients to think about and accelerate regionalization, how they think about production. So a lot of the things that are going on should also increase investments and activity. At the same time, of course, keeping in mind that some clients are hit harder than others, and there will be profit downgrades from Nordic clients as well, and we've certainly seen that in the past few days.
Carsten, tie that then. Good morning, Tom here in the studio. Tie that then to the credit picture. What is credit quality looking like right now? What is your outlook for that credit quality in the quarters ahead? And are you comfortable with provisions as they're currently set?
Yeah, so we continue to see a very strong credit quality and very low levels of delinquencies, very limited deterioration in credit exposure. Keep in mind, and particularly in Denmark, which is more than half of our business, unemployment is at record lows. And again, the economy has been strong. So right now, we're not seeing any evidence of credit deterioration. No doubt there will be some downgrades in terms of rating migration as some companies downgrade and therefore EBITDA reduces, and that plays into some of the credit migrations. But overall, we feel comfortable. We guided to 1 billion of credit losses when we came out with our year-end results in February. And in fact, we haven't changed those outlooks. And although we see some revisions of slightly slower growth across the Nordics, we don't believe that will have a material impact on credit quality as we look forward, given what we know today.
Carsten, good morning. It's Lizzie here. You mentioned some of the increase in European spending. I know that you have lifted restrictions so that you can invest in practically all EU defence firms. And I get that we're in this new era of rearmament, but I just want to clarify, what was unethical about them before but doesn't apply anymore?
Yeah, I think if you take a step back, our primary role is to help our customers and clients, both in terms of helping large defense companies in the Nordics who've been clients of us for a long time, helping them with their business. Clearly, there'll be more activity there, but also to help our clients on the investment side in terms of accessing defense stocks, defense investments. There's no question there has been a huge sentiment change around the defense sector over the last couple of years. And, there is a clear strategy to rearm Europe. There is a clear commitment from European countries to spend more on defense as percentage of GDP. If you look at Denmark, We've committed to spend 25 billion Danish kroner more incremental in 25 and 26, which takes our spending in Denmark to over 3% of GDP. So our role is to make investments available to our customers and clients. And that is also why we re-looked at all the defense companies that you can invest in Europe. And we have increased the universe by somewhere more than 30 companies recently, so that, again, our customers can have access to those investments.
And indeed, we've seen a tremendous boost to those names in this era of rearmament. Rheinmetall and Saab, Thales, all in the green this morning. Carsten Eggeris, CEO of Danske Bank, we thank you for your insights after those earnings. But coming up on the programme, a look ahead to the first non-farm payrolls print since the Trump administration's tariff tumult. That's next. This is Bloomberg.
Welcome back to the opening trade. 50 minutes into today's session, we are seeing green across the screen. Outperformance when it comes to the CAC 40, I think, or DAX, excuse me. Eyesight is poor on this Friday, but it's really important to keep an eye on some of these kind of indexes in France, in Germany. A bit of a catch-up trade. It's a lot of the markets that were closed yesterday. The FTSE 100, you can see, is not outperforming to the same extent, but still higher in terms of risk sentiment. Of course, we are looking ahead to U.S. non-farm payrolls due later today. That first since Donald Trump's administration's tariffs kicked in. Let's bring in Bloomberg's Valerie Teitel for more. Val.
That's right, Kriti. Happy Payroll Friday. We've got the jobs numbers coming across the tape at 1:30 p.m. London time. Now, I think the risk is that the market overreacts to a weak print and shrugs off a strong one. If we get a strong print today, I think we might not give it too much weight. We might just toss it off as this is some pre-tariff news. But the headline consensus estimate is for 138K jobs added to the U.S. economy. Unemployment rate is expected to stay steady at 4.1%. A lot of economists out there warning that this could be the last strong print before we get some tariff-induced weakness coming in the prints in May and June. But will it keep this equity market on a tear? We have notched now 8 straight days of gains for the S&P 500 index. Futures are looking positive. Over the 9 sessions, we've gained over 9%. And if we do end up in the green today, that would be the longest streak of gains for the U.S. equity market since 2004, a record not seen for 20 years. I don't want to jinx it, but the longest record for the S&P 500 is 14 days. That was seen back in the 70s.
Certainly something we're going to be keeping an eye on. Does the winning streak continue? Bloomberg's Valerie Teitel walking us through some of those markets. We thank you so much, Lizzie.
So it's jobs day. We're looking ahead to the data. Let's get some analysis and a preview with Freya Beamish, chief economist over at TS Lombard, who joins us now. Freya, good to have you. From the data that we've seen so far, are we heading for a recession in the US economy?
It seems strange. All of my sort of technical terms as an economist don't seem quite appropriate. But when I look at the data, my job is to try to dissect the noise from the trend. The word noise seems inappropriate given the scale of disruption that has been rippling through the global economy and markets. But at the moment, when I look at the data, what I see is noise around an economy that is still relatively resilient. Now, when we look at the jobs data, yes, challenger job cut announcements have increased. If we take out the government aspect of that, yes, the private sector is at the sort of the top of the range, but not really consistent with recessionary dynamics. Initial jobless claims have also jumped, but there seems to be some sort of statistical problems there with regards to seasonal adjustment, in particularly with regards to New York. And then looking at the GDP data, yeah, there is obviously a lot of noise in those data, but the domestic demand looks okay. Yes, of course, people are leery of spending, but what do we really expect in this environment? So we're really in it. We're kind of in a major shock. The survey data have deteriorated, but those can sort of turn around quite quickly. And what I'm looking for when I'm trying to assess whether there's going to be a true recession is whether there's anything that can cause the reflexivity to sort of kick in the labor market. Not just thinking about today's print, obviously, but just sort of more broadly. And without the full extent of the tariff shock, there isn't really an area of the labor market that seems to need to correct, and so it's hard to see there being a recession without that sort of full whack of the tariff shock. The only kind of area of the labor market that looks sort of slightly out of shape is there seems to be a little bit more in terms of construction jobs as compared with the health of the housing market. But everything kind of post-COVID bubble, tech, logistics, that's all sort of corrected back down to previous trends. So you really need the tariff shock to be big enough for profits to be contracting by enough for firms to really want to fire people. And at the moment, we've kind of held consistently that we think that the tariffs are going to be broadly negotiated away, and so it's a 1.5% growth story rather than an actual recession with reflexivity kicking in.
Freya, can I zoom in on part of that tariff story then, because you are holding out hope of a US-China deal. Some of the signals I've seen from Beijing suggest that they're digging in for the long haul. You don't see that. You see a Beijing that is maybe willing to make a deal.
Yeah, people always talk about face in China. I think face is pretty important everywhere. But I think, if I was in Xi Jinping's position right now, going into this year, I would have said that the US held all the cards in terms of the economic bargaining position. And then the US just completely overplayed its hand. So if I was sitting in the Chinese position right now, I would want to let the US position sort of sweat it out a little bit. But I would also be cognizant of the fact that my own economy is not in great shape. I've got sort of the Chinese economy has a nascent recovery, a very, very timid recovery that is based on rebuilding the confidence of the consumer sector after the housing crash, after the destruction of wealth in China. And what they really need is some form of stability so that can continue. At the moment, they're having to really focus on the renminbi, prevent that from depreciating to antagonize Donald Trump, and that is preventing their recovery from continuing.
Right. Freya Beamish, Chief Economist at TS Lombard. It's all we have time for. Too short as always, but we appreciate your time this morning. That does it for the opening trade. The Pulse is up next. You are seeing equity markets in the green across Europe. We're going to see if that sticks into the weekend. Stick with us. This is Bloomberg.